Hello, students. Welcome to Section 3 of Chapter 7 on financing government. And this is going to be the most difficult section of the chapter, but it's probably the most important. And I would say most of your questions from the test will come from this section. The government funds its operations through various taxes. You want to understand those taxes as well as loans. Government spending is divided into two main types of spending: mandatory spending and discretionary spending. And the president works with Congress to create a budget to fund the vast number of government programs and activities. The government's fiscal and monetary policies can and do affect the economy. So we're going to talk about how is the federal government financed. Well, the federal budget is huge. In 2017, it was $4.1 trillion. That's $12,700 for every person living in the United States, and that represents 1/5 of the nation's gross domestic product, which is the market value of all goods and services produced within the United States within a year. It's projected the government in 2017 would receive about $3.6 trillion, which meant there was a shortfall of $500 billion, or $500 billion. That shortfall amounts to $1,500 for every person living in the United States. That's a lot of money. So how does the government pay for what it does? Well, there are two sources of revenue for the government. One is they collect revenue from taxes, various types of taxes we'll look at, and then they can also borrow money. The problem with borrowing money, as you well know, is that eventually you have to pay it back. So let's look at, first of all, the source of income collecting revenue. Income taxes, you've heard of them, and maybe you have participated by having some taxes taken out of your paycheck. The Constitution limited taxation initially to excise tax. That was a tax on a specific good, and income taxes were against the law. However, with the 16th Amendment passed in 1913, Congress gave the power to tax personal and corporate income, and so was born the income tax. Income tax is defined as a tax on a person or corporation's income, and 49% of federal revenue comes from individual income taxes. 12% of federal revenue comes from corporate income taxes that are paid by companies. Income tax tends to be a progressive tax. That is, a tax that increases as the amount that is subject to taxation increases. So, for instance, if a person makes $1 million, they pay a higher tax rate than a person who makes $50,000. So the tax rates go up. And here is a Revenue Act of 1913, typically how much people paid in taxes. You can take a few minutes to look at that, stop the video and look at it if you want. And you see here, if you had income of $199,000, this is how much you pay. This is back in 1913. And so if you had an income of $500,000, you would pay income tax of around $35,000. Single tax income bracket rates for 2017. You can stop it again and look at these. And marriage filing joint 2017. These have changed somewhat recently. Payroll taxes. Payroll tax, don't get this confused with income tax. Payroll tax is money that is withheld from a person's paycheck by the employer that goes to cover Social Security, Medicare, Medicaid. These are payroll taxes. Income tax is not a payroll tax. These payroll taxes are in addition to income tax that your parents would pay. And these payroll taxes constitute about 31% of federal income. And they are a regressive tax. The payroll tax is a regressive tax that has a greater impact on lower income earners than higher income earners because the tax stops increasing at a certain point. For instance, if you make Social Security, let's take Social Security for instance. It maxes out at $118,500 income. So if I make $100,000 income, I pay the same percentage as someone who makes $30,000. Now I pay more taxes, but it's the same percentage. That is called a regressive tax as opposed to a progressive tax. You want to make sure you understand the difference between a regressive tax and a progressive tax. And then Medicare is a proportional tax. A proportional tax is a tax that is applied at the same rate against all income. It's also regressive in that the same rate is applied to all those paying taxes. Now, a good example of a proportional tax is sales tax. Everybody pays the same amount for buying a loaf of bread. It doesn't matter whether you make a lot of money or very little money. You pay the same amount of tax on that bread. There are some other sources of government revenue. Government collects taxes amount to about 5% of federal funds from excise taxes, tariffs, estate tax. Person dies and they have to give so much of their estate, and a gift tax as well. The largest non-tax revenue source is the interest rate earned by the Federal Reserve System. And this gives a good breakdown of sources of revenue. You can see here, most comes from individual income taxes, social insurance and retirement receipts, 31%, corporate income taxes, about 12%, and then excise taxes, about 3%, and other taxes, about 3%. So that's one way that they get their money at the federal government, income. Other way is borrowing money. They sell bonds. A bond is a financial instrument by which a borrower agrees to pay back borrowed money plus interest at a future rate. I might buy a U.S. bond at, say, 10% interest, and I give the government, I buy the bond for $100, and they agree at some future date they will pay me back at $110 for that bond. And the United States has historically borrowed or sold bonds only in emergencies. During wartime, they were big. But recently, they have become a matter of course. The federal debt is huge. Currently, and I haven't updated, but it is in excess of $20 trillion. Now it's in excess of $24 trillion. And your book has a great deal. How do you, that's a lot of money. But so is $1 billion a lot of money. So is $1 million a lot of money. And there's a example of an aircraft carrier that you want to do well to read at the first part of the chapter. But interest alone, paying interest alone on the federal debt amounts to 7% of the budget. And a growing federal debt threatens our discretionary spending. You'll recall there are two types of spending, discretionary and mandatory. And the growing federal debt threatens our discretionary spending. And I want you to click on these when you get it. This is the debt clock. I'm not going to click on the other ones, but the debt clock, I think you can see. And it is running. Anyway, but go to this, this particular, you can check out all three of these websites, and I would encourage you to do that. It would give you a good idea of our debt, but especially the U.S. debt clock, see what it's running, see how much each individual family owes for our national debt. Very sobering. Okay, government spending. We have, again, mandatory and discretionary spending. Mandatory, you have to spend. And discretionary, you can kind of move it around. Mandatory spending is the spending required by laws and not subject to the annual budget process. And it has risen. That amount has risen. It was about 26% of the budget in 1962. It now constitutes about 73% of the budget. Discretionary spending is spending that is subject to the annual budget process, and it is about 27% of total federal budget. And this is a collaborative effort between the President and the Congress. They work together on the budget. The budget process, you want to know this, it reflects the nation's priorities. Fiscal means financial or having to do with money. I would say let's get fiscal. Let's get fiscal. Not physical, but fiscal, dealing with money. Federal government's fiscal year begins on October 1st and ends on September 30th of the next calendar year. And you want to make sure you know this. The budget is named for the year in which it ends. So, for instance, we are in fiscal year 2020 right now. It will end September 30th, 2020. President's budget, this is a process that you want to be familiar with. In 1921, a formal act of Congress gave the President the job of preparing and presenting a budget which he presents to Congress. The OMB, the Office of Management and Budget, assists him with its creation. And the OMB gets input from all those who are working in the executive department, the various heads of the departments, as well as the independent agencies. And he gets that, they crunch numbers, and then the budget is to be completed before the State of the Union in January for the upcoming year. Offers spending proposals for the upcoming fiscal year, as well as estimation of revenues and spending for several years down the road. The budget in Congress, the President has to have the budget to Congress by February 1st. Congress uses the President's budget as a guide. They are assisted by the Congressional Budget Office, and they try to create their own budget based on what the President has given them. The House and the Senate are working separately, but they hold hearings. They gather input from members of Congress regarding the budget. And then the House and the Senate must pass a concurrent resolution. And the resolution has to pass in both houses, and it marks an agreement, this concurrent resolution, on how much the total budget will be for the upcoming year. And then the House and Senate Appropriations Committee go to work on that budget in each of the respective chambers, budget committees, appropriation committees. They produce the final product. Then the appropriation bills, they come together, and once again, they agree on it, and then they send it off to the President to be signed. And they have to have that completed by October 1st. And if Congress fails to complete the budget, then the only way the government can stay open is with a continuing resolution. And it has to be approved by both Congress and the President. If President and Congress can't agree on a temporary funding government, if they can't pass this concurrent continuing resolution, then the government's going to shut down. And that's happened a couple of times. Here's the timeline. April 1st, first Monday of February, President submits his budget. It's followed by the State of the Union. April 15th, the House and Senate Budget Committees send a concurrent resolution so that they are agreeing on how much is going to be spent by May 15th. And then June and September, they work in their conference committees to decide the issues on appropriating the money. September, the appropriation bills are passed by both the House and Senate and sent to the White House. And then the President needs to sign it by October 1st for the budget to begin that year, October 1. Fiscal and monetary policies. There are two policies. Fiscal deals with money. Federal government, through the process of creating a budget, implementing tax laws. Monetary policy is created by the federal government, but it's regulated